So let's start then. My presentation will be useful for everyone who thinks of their own business ideas as well as beginner investors. So the ideas that I'm going to talk about are taken from a book of Peter Thiel called 0 to 1. Also, I put some thoughts from Elon Musk's biography as well as some things from my personal experience. Let's start then. So there is no many ways you can get enough funds to start your own company. I don't consider bank loans or support of your relatives here, and also assume that there are few people who can afford to run a startup from their own pocket. Said that, we can see that there are only two ways you can get significant resources to start your IT business. The first one is venture capital investments. The second one is angel investments. And the last one is crowdfunding. Well, I treat venture investments and angel investments as almost the same. The only difference is that usually behind a VC, there is a group of people. On the other hand, an angel investor usually is a single person. But crowdfunding is a completely another deal, and you can see that it's growing significantly thanks to cryptocurrencies and ICOs. However, ICOs and crowdfunding is not a part of this presentation, but I will share our experience and knowledge in that area in a separate talk or a blog post. Today, we're going to talk about VC investments only. But let's start from the beginning. Everything starts with idea, and most commonly it fails on this stage. As everybody knows, behind every great idea there is a secret, a truth that the majority doesn't know. One of the questions that Peter Thiel asks startup founders and his new employees is, what important truth do very people feel agree with you on? It may sound like one of those nonsense questions that HRs ask you on interviews, but there is a deep sense between in this question. Most often you will hear something like, our education system is broken, or there is no God, or politics is a dirty game. But these are not secrets. These are obvious things or controversial topics for endless arguers. And here are some truths held by famous people these days. The first one obviously belongs to PayPal founders. Sending paper checks over email is not convenient. The second one belongs to Mark Zuckerberg. College students would like to know more about each other through the internet. And the last one lies behind the idea of Amazon. It is challenging to think of good secrets that can grow into business ideas, because it makes you think unpopular things. Everybody knows everything you learn at school or college, but startups is an ideal tool to invent breakthrough technologies and new markets, because you can convince a small group of people to follow your truth and try it out. On the other hand, it's more challenging to develop not really popular ideas in big companies, obviously, because the majority of people do not share your ideas. Okay, to get a venture investment, you need to think and understand how venture capitalists think. Serial investors understand how to make money and have a good understanding of how economics works. They understand some secrets that the majority doesn't know. Okay, let's get to that secrets. To go further, we need to clean up one more important thing. Let's talk about monopolies. Are monopolies evil? You can hear from TV and read on newspapers that governments fight monopolies. They create new laws and restrict monopolies to try to make their market competitive. Let's read the definition of perfect competition from Investopedia. So Investopedia defines perfect competition, which is opposite of monopoly, as a theoretical market structure in which the following criteria are met. All firms sell an identical product. All firms are price takers. Market share has no influence on price. Buyers have complete or perfect information, and firms can enter or exit the market without cost. Well, sound good for us as consumers, right? But let's dive a bit deeper and discuss long-term effects of perfect competition and monopolies on an example that everybody knows, Google. Okay, is Google a monopoly? It's a tricky question. Let's consider Google as a search engine. It owns about 70% of the market. When you talk with your friends and search something on the internet, you say Google. Google is an official term from Oxford Dictionary. So it owns the market completely, and its brand name became an official term for the whole industry. Does that mean that Google is a monopoly in the search engine market? Well, I think yes. And a tricky thing about monopolies, they do not call themselves monopolies and hide that, because people hold negative stereotypes about all monopolies and treat them as something bad. We can consider Google as advertising company because about 90% of its revenue comes from search advertising. In this case, we see that it holds only 3.5% of the global market, which is not much in fact. Also, we can treat Google as a technology company and compare its revenue to the global IT market. Well, as you can see, it is a drop in the ocean. Is Google a monopoly or not? Whether or not Google is a monopoly is a controversial question, but almost all their revenue comes from search advertising, and about 70% of the search market belongs to them. However, they make a good job on hiding this. Okay, now let's go a bit more deeper and talk about the ways of growth in economics. Everybody knows that there are two ways of growth for economics: extensive and intensive. Briefly speaking, extensive way leads to a huge number of similar businesses that produce same product. It leads to a perfect competition market. From the other hand, extensive development usually caused by new processes or inventions. In the case of information technology industry, it usually caused by new technologies. Let's stop here for a minute and think more. Let's assume that you own a business in a competitive market. It means that you run a company that is similar to hundreds of other companies. Also, it means that you fight for survival every day, trying to minimize your expenses and make prices to stay competitive. Obviously, it means that you do not have resources to make long-term plans or invest into something new. You won't be able to make a breakthrough in the technology world. At the same time, new technologies lead to extensive development. New technologies matter more than from global perspective than perfect competition market. Only new technologies and extensive development lead to positive changes in the world. And here an interesting conclusion comes. Monopolies are more beneficial in long term. Only monopolies have enough resources to invest into new technologies and researches. Only monopolies can afford to pay their employees more and hire top talents. At the same time, monopolies are able to earn huge money because they own entire markets. Moreover, from the business perspective, building your business in a competitive market will not allow becoming different from the rest of the market. and you can get stuck in competition with minimal profits. And we can see that smart ventures look for potential monopolies. Well, it's easy to understand. Every investment is a huge risk because first of all, you invest into people, and humans are unpredictable creatures. As an investor, when you take this risk, your price should be not 10x, but 1000x at least. It's logical that only monopolies can give you such growth. I'm sure that you heard about some crazy investments. For example, there is a startup in Japan that is going to use the moon for advertising purposes. There was a huge hype around them when they raised their first millions. Now I understand the thinking behind such investments. If you are a serial investor and every investment is a huge risk, why won't you throw a couple of millions on the idea that can monopolize the moon? Well, seems to be pretty logical. But how investors usually distinguish monopolies among other businesses? Here are monopoly attributes formalized by Peter Thiel. Well, the first one related to technology. Monopoly business usually own a technology that is impossible to replicate easily. Obviously, it creates a barrier for competitors to get into the market. A good example is Google search algorithm, which uses machine learning and more than 600 factors to determine search ranking. The second one is network effects, which make product more beneficial for customers as more people use it. It's a straightforward one. A good example is Facebook friend list. It creates more value as more of your friends use Facebook. The third one, called economies of scale. Briefly speaking, it gets stronger as it gets bigger. Well, it's common for our industry because marginal cost of producing another copy of software is zero. And the last one is brand. Monopolies create a culture around their brand and try to make people associate their brand with the whole industry. Well, good examples are Apple and Google. Apple specifically for North America. Okay, and apart from these attributes, investors pay a lot of attention to ability to generate cash flows. Here is a definition of cash flow from Investopedia. An important note here, please don't mix cash flows with revenue or profit. You can see the definitions here. Briefly speaking, a company's revenue is the amount of money that the company receives without any deductions or expenses. Profit is the amount that remains after deduction of all expenses. But cash flow is different. It's related not only to money, but to its equivalents. And also it can be negative if a company has higher flows moving out of the business. One significant note here, you may not have cash flows already. Investors are looking for ability to generate them in future. Also, please keep in your head that the majority of IT startups are not profitable first couple of years and become profitable after 3 or 5 years. So don't be afraid to reflect negative profitability in your business plan. Experienced investors appreciate future cash flows more. Okay, we can review Uber example. Here is Uber's revenue between 2013 and 2015. As you can see, their revenue was growing significantly, but as everybody knows, their company is not profitable even today. But this picture shows that Uber was able to generate and increase cash flows that was looking attractive for investors. You know how much Uber has raised from venture capitals. Those are fantastic numbers. And let me repeat one more time. As you know, Uber is not profitable even today. It means that they are able to generate large cash flows, but they are not profitable still. Anyways, investors look at cash flows in more detail and pay attention to perspectives of your startup more than the current picture. Okay, and the last thing investors pay attention to is durability. It comes from the previous point that IT startups bring profits to their investors after a couple of years. So here is a logical question comes up. Will your startup be able to survive until it becomes profitable and generates significant cash flows? It's hard to predict, but it's closely connected to your idea and your initial market. For example, if your startup is a trendy restaurant, it may be growing only until the trend is alive and most likely will stuck in competition in long term. So now let me summarize quickly what I said before. So the ideal startup in the eyes of venture capital investors is a startup that first owns a unique technology that cannot be reproduced easily. The second, it dominates or tends to dominate a very small market. The third, able to scale at a bigger market without marginal losses, brings more profit to consumers as more people use it, able to generate cash flows in future, will be still relevant a decade from now. Well, I hope now you will better understand how venture capital investors think, and based on this, you will be able to evaluate how good your startup idea is. Thanks for your attention. That was the first part of my talk about startups. I hope it was useful. If you have any questions, feel free to ask.
Yeah, thank you. I have a question. Do you think it's possible to launch your own startup without getting VC money?
Well, it depends. If you mean that you're not going to raise any investments at all, it could be challenging, but you can use crowdfunding, for example.
The second question is about big companies. When I listen to your presentation, I imagine my startup should grow really big, for example, to thousands of people. And on the other hand, we have examples like Basecamp, who intentionally stay small and they are profitable and they can hire top talents and everything. What do you think about it? Should I, when I start my startup, should I really think about growing it to thousands of people, to hundreds of people?
Well, I was speaking about how attractive it will look like for venture capital investors. If you present in your business plan that you are not going to grow into a large company, most likely you will not get a venture investment, because they don't invest money usually in small businesses. It doesn't make sense for them because every investment is a huge risk and they are looking for huge profits.
Yeah, got it. Thank you.